Hello, everyone. Welcome to KPMG's podcast covering Emergence Issues Task Force Issue 13F, Classification of Certain Government Guaranteed Mortgage Loans Upon Foreclosure. The EITF met on June 12, 2014 and reached a final consensus on this issue. The FASB ratified the consensus at their July 16th meeting, and the ASU was issued on August 8, 2014. My name is Billy Williams, and I'm a senior manager at KPMG's Department of Professional Practice, and I'm joined here with my colleague in the department, Haley Krebs. This podcast was recorded on August 15, 2014, and for a few minutes, we will highlight some of the key considerations addressed by EITF 13F. So, Haley, can you give me some background on this EITF issue, and why is it brought to the task force?
Sure, Billy. I'd be happy to. This issue came about as a subset of Issue 13E, which was recently released as ASU 2014-04. Now, that issue addressed when a loan should be reclassified out of loans receivable, and that's generally upon foreclosure or receipt of a deed in lieu of foreclosure. And EITF 13F addresses where certain loans should be reclassified. The issue only covers mortgage loans that are guaranteed by a government agency, so privately insured mortgages aren't within the scope of this issue. It was brought to the EITF due to diversity in practice, so some creditors were classifying these foreclosed loans as other real estate, and some were classifying them as other receivables.
So I know there are a number of guarantee programs, so which guarantee programs are we talking about here?
Well, there are really two types of government guarantees, fully guaranteed and partially guaranteed. A full guarantee is usually done through the Federal Housing Authority and HUD, and I'll walk through an example of how those FHA guarantee programs work. Let's say that we have the Bank of Midtown, and it holds the mortgage for Mr. Smith with an outstanding principal balance of $200,000, and that is guaranteed by the FHA. Now, Mr. Smith is having some financial trouble, and unfortunately the bank has to foreclose on his home. At the time of foreclosure, the Bank of Midtown takes title of the property and conveys that title over to HUD. Now, that may not happen concurrently, but it happens within a relatively short time frame, about 30 days or something like that. So there may be a period of time when the bank actually holds the property, but it's expected to be short, and because the full principal balance is guaranteed, there's no risk associated with changes in the value of the property. Next, the Bank of Midtown submits its claim under the guarantee to HUD, and once HUD makes sure everything's in order, processes the claim, the Bank of Midtown can collect its $200,000.
All right, so I understand that for the FHA, so that's 100% guaranteed. So what about situations where you said there's a partial guarantee?
A partial guarantee works sort of like the full guarantees, but there are some key differences. There are several governmental agencies that provide partial guarantees, but the most common are the Veterans Administration, or the VA, and the U.S. Department of Agriculture. The terms of the guarantees under the different agencies vary, but I will walk through a VA program loan as an example. So we'll use the same basic facts as the FHA example, but this time Mr. Smith's loan is guaranteed by the VA. When the foreclosure proceedings are nearing an end, the Bank of Midtown is going to be required to get an appraisal of Mr. Smith's property, and let's assume that it comes back only worth $100,000. So they go through with the foreclosure and take title to the property, and then this is where it gets a little different from the FHA example. Under the VA guarantee, the bank doesn't have to convey the property to the VA. They can choose instead to hold the property and sell it on their own. The appraisal they obtain prior to foreclosure is going to be used in the calculation of the amount that the VA will pay under that guarantee. A couple of other terms with the VA guarantees: they're currently capped at $50,000, and they also charge a holding fee if the property is conveyed to the VA, which is 15% of the fair value of the property. So for our example, the amount recoverable from the VA would be calculated as the fair value of the home, less the 15% holding cost, plus the guarantee up to the $50,000 maximum. So if you add all that up, you're going to get, or the Bank of Midtown is going to get $135,000.
So I presume there's currently diversity in practice. So what different options did the EITF consider for the treatment of these government guaranteed loans?
There were a couple of different options that they considered at the November 2013 meeting. They were to separate the property from the guarantee, classify them as other real estate owned and a receivable separately, to leave them in loans, to classify the entire amount as other real estate owned, or to classify the entire amount as a receivable. They decided that separating the guarantee and the loan really wasn't appropriate because there aren't two units of account for these types of loans, so that wasn't an option. And then leaving them in loans also isn't appropriate because ASU 2014-04 says that you have to classify them out of loans upon foreclosure. So that really left the OREO classification or the receivable classification, which were really the two options that most creditors were doing anyway.
So then which one did they decide to do for the final ASU?
The EITF reached a final consensus at their June 2014 meeting that certain government guaranteed mortgage loans should be reclassified as a receivable upon foreclosure. So there are essentially three criteria that must be met to be in the scope of this issue. First, the loan has to have a government guarantee that's not separable from the loan before foreclosure. Second, the creditor has to have, at the time of foreclosure, the intent to convey the property to the guarantor, the intent to make a claim on that guarantee, and they also have to have the ability to recover under that guarantee. So if you go back to our VA partial guarantee example, the bank had the choice of whether to hold and sell the property or to convey it to the VA. If they had decided to hold it, then that loan would not have been within the scope of this issue. The last criterion that you have to meet is that any amount of the claim that is based on the fair value of the real estate has to be fixed at the time of foreclosure. For the FHA, that's easy because the guarantee is based solely on the outstanding principal amount and not the value of the real estate. For the partial guarantees, in our example, the bank was required to get the appraisal before foreclosing, and then that appraisal is what was used in the calculation of the recoverable amount. So even if the fair value of that property had gone down after the foreclosure, the bank would still be able to collect the amount calculated using the appraisal, so it would be within the scope of this issue. The amount that they expect to collect under the guarantee is what they have to record as the receivable. So under a partial guarantee, the bank has to write down the loan to the recoverable balance before reclassifying it. For most partial guarantee programs, though, they already require you to do that before conveying the property to them anyway.
So isn't this a little different from the way the exposure draft was written?
It is actually. The exposure draft was much more limited, and it only included the fully guaranteed loans and then only for residential mortgages. But based on feedback from the comment letter process, the EITF decided that the scope should be expanded to cover non-residential loans as well as these partial guarantees. So they changed the criteria when they issued it as ASU 2014-14 back in August.
Thanks, Haley. So can you let me know what the transition options and the effective date is?
Sure. I did want to mention, though, that there are no additional disclosures or anything as a result of this ASU being issued. But the transition options are prospective or modified retrospective. The transition method selected has to be consistent with what the entity chose for ASU 2014-04. So if the bank is going to implement ASU 2014-04 prospectively, then they have to do that for this one as well. An entity can also adopt the guidance early, but only if they have already adopted ASU 2014-04. It's going to be effective for public business entities for fiscal years beginning after December 15th, 2014, and interim periods within those years. And then for all other companies, it will be effective for fiscal years ending after December 15th, 2015, and interim periods thereafter. So really that's a fancy way of saying that for a calendar year end company, it's going to be effective for December 31st, 2015, but then interim periods for entities that aren't public business entities will be a year later.
Thanks. So I think that's a pretty good summary of issue 13F. You can find more information on our financial reporting network, including our defining issues on this and other recent EITF issues. Thank you for listening.